I didn't learn advanced risk management from textbooks, kid, and I sure as hell didn't learn it from winning trades, because wins have a dangerous way of hiding risk until it's too late. And back when I was younger, I thought risk management meant nothing more than placing a stop loss and sizing my position small enough to sleep at night. But that was surface-level thinking, the kind that keeps you afloat in calm waters and gets you killed when the storm really hits. The deeper lessons came later, through losses that didn't just sting, but threatened my ability to stay in the game at all losses, that forced me to confront the uncomfortable truth that survival in the market has less to do with how much you make on good days and everything, to do with how little you lose when conditions turn against you. I remember the first time I experienced a real drawdown, not a bad week or a rough patch, but a sustained erosion of capital that ate away at both my account and my confidence. Each loss on its own was manageable, well within my acceptable risk, but together they formed something far more dangerous, a psychological drain that clouded my judgment and pushed me toward desperation. That's when I learned that managing risk isn't just about individual trades. It's about managing sequences of trades, because the market doesn't hurt you. One cut at a time, it bleeds you slowly until you're too weak to recover. I began to study my equity curve the way I once studied charts, looking for patterns in my own behavior, noticing how performance degraded after certain levels of drawdown, how my decision-making suffered when my capital dipped below thresholds I hadn't even known existed. And that's when I introduced the first advanced rule that truly changed my career risk reduction during drawdowns. When my account dropped by a predefined percentage, my position sizes automatically shrank, not because the market had changed, but because I had. My emotional resilience wasn't the same, and pretending otherwise was arrogance disguised as confidence. That single adjustment saved me from digging holes I couldn't climb out of more times than I can count. Then came correlation risk, a silent killer most traders don't see until it wipes them out. I used to think I was diversified because I traded multiple instruments, but in reality, I was stacking the same trade in different costumes. When markets moved together, my losses multiplied, not added. It took one brutal week during a macro-driven sell-off for that lesson to sink in, watching several independent positions collapse in unison, exposing the flaw in my thinking. From that point on, I stopped thinking in terms of trades and started thinking in terms of exposure. I capped my total risk across correlated positions, understanding that correlation spikes precisely when you need diversification the most. That mindset shift from isolated trades to portfolio-level risk marked the point where I stopped trading like a gambler and started operating like a risk manager who happens to trade. Another hard-earned lesson came from volatility itself. I learned that risk is not static, it breathes. The same position size that feels conservative in a quiet market can be reckless when volatility expands. During the 2008 crisis, and again in the COVID crash, I watched traders blow up, not because their strategies stopped working, but because they failed to adjust to changing volatility regimes. So I learned to let the market dictate my size. Wider ranges meant smaller positions. Calm conditions allowed more flexibility. It wasn't about prediction, it was about adaptation. Advanced risk management is less about control and more about responsiveness. And then there's the concept most traders avoid because it feels morbid risk of ruin. I didn't take it seriously until I saw it firsthand, watching skilled traders with solid edges disappear from the game because their risk per trade, combined with bad luck and human emotion, pushed them past the point of recovery. That's when I began modeling not just best-case returns, but worst-case scenarios, asking myself, not, how much can I make, but what sequence of losses can I survive? That question changed everything. It forced me to accept lower short-term returns in exchange for long-term viability, a trade-off only those who've stared ruin in the face truly understand. Capital preservation became my primary objective, not because I feared losing, but because I respected time as the most powerful edge a trader can have. Over the years, through multiple cycles, I refined my approach further, learning to separate strategy risk from execution risk, to step aside when conditions no longer matched my edge, to recognize when I was trading well, but still losing a crucial distinction that prevents emotional overcorrection. I learned to keep dry powder not as missed opportunity, but as insurance, a buffer that allowed me to act decisively when true opportunity emerged. And slowly, almost without noticing, risk management stopped being a set of rules and became a way of thinking, a lens through which every decision passed before it ever touched the market. Today, when I look at a potential trade, the question isn't whether it will win. It's whether it deserves to exist within the larger structure of my risk. Does it align with current volatility? Does it increase correlation exposure? Does it threaten my drawdown limits? Does it respect the fact that survival is non-negotiable? Because once you've lived long enough in this world, you understand that the market will always offer another opportunity. But it will not forgive you if you bet too much of yourself on any single one. And the traders who endure are not the boldest or the most brilliant, but the ones who learn to protect their downside so relentlessly that they earn the right to stay in the game long enough for probability to finally work in their favor. And that understanding only truly settles in when you stop asking how to win and start asking how to survive long enough for your edge to matter. Because once that question becomes your compass, everything else in trading starts to fall into place. And I remember a period late in my career when that mindset was put to the ultimate test, a slow grind where opportunities were scarce and volatility lurked just beneath the surface, tempting traders to overextend themselves just to feel productive. And it was there that advanced risk management proved its quiet power, not by making me money quickly, but by keeping me intact while others slowly unraveled. I learned to think in terms of layers of defense, not single lines of protection, understanding that stops can fail, correlations can spike, and models can break. But a mindset built around preservation adapts when tools don't. I capped daily loss limits not as a punishment, but as a circuit breaker for my psychology, knowing that once emotional fatigue sets in, even the best strategy becomes dangerous. I respected time stops as much as price stops, exiting trades that went nowhere, not because they were losers, but because stagnant capital is a hidden form of risk that drains focus and invites impulsive decisions. I learned to stagger entries and exits to reduce exposure to sudden shocks, to scale down aggressively during uncertainty, and scale up only after stability returned, never confusing courage with recklessness. And perhaps most importantly, I learned when not to trade at all, stepping aside during regimes where my edge historically underperformed, accepting that inactivity is sometimes the highest form of risk management. These choices didn't make headlines, didn't feel exciting, and didn't satisfy the ego, but they compounded into something far more valuable than fast profits resilience. Over time, I watched traders with sharper strategies and faster reflexes disappear undone, not by lack of skill, but by a single period of poor risk control they never recovered from. And that reinforced a truth I carry with me. To this day, markets don't end careers with one bad trade. They end them with a series of manageable risks that were never managed as a whole. When you truly internalize advanced risk management, you stop seeing losses as failures and start seeing them as expenses. The cost of doing business in an environment where uncertainty is the only constant. And that shift frees you from the emotional whiplash that destroys consistency. You become less reactive, less desperate, more deliberate. You stop trying to force outcomes and start positioning yourself to endure them. And kid, that endurance is what separates the traders who last from those who burn bright and vanish. Risk management at its highest level isn't about fear, it's about respect. Respect for uncertainty, respect for probability, respect for the fact that no matter how experienced you become, the market can still humble you if you forget your place. As I sit here now looking back across decades of trades, the wins blur together, but the moments where risk management saved me stand out with brutal clarity, because those were the moments my career could have ended and didn't. And if there's one lesson I want you to carry forward, it's this: you don't earn longevity by chasing upside. You earn it by defending your downside, with patience, structure, and humility. And if this story helped you see risk, not as a constraint, but as a foundation, take a moment to leave a comment with your thoughts. And don't forget to subscribe so I can keep passing down the lessons the market spent a lifetime teaching me.